Mark my words, if this goes on, I'm not saying it will go on. If this goes on, it doesn't get worse. It gets much, much, much worse. If we weren't already in a recession, that this conflict has tipped us into a global recession. The Fed has one choice, really, which is to print. There you would get a run on the bank with no FDIC. I'm not saying this is going to occur, but it causes me a lot of concern.
Rick Rule is back with us. He's a founder of Battle Bank, founder of Rule Investment Media, former CEO of Sprott U.S. Welcome back to the show, Rick. Good to see you again.
Always a pleasure to be David. The better for being back on with you.
Always a pleasure to have you. You were on the show not too long ago, a couple of weeks ago, about a month and a half ago. You had warned us about the troubles of inflation. That would be the outcome of the closure of the Strait of Hormuz. We're still at a point where the Strait of Hormuz is closed. The ceasefire did not last very long. And now, on the 13th of April, Trump has announced that the U.S. naval blockade of the Strait of Hormuz is in effect. Inflation has now ticked up to the highest point since 2024. So your warning was rather prescient. What is next for inflation? There's two ways to look at it. One, that oil is going to remain at $100 or near $100, and that's going to be the new reality. Or perhaps this spike in oil was transitory. But even if that were the case, some of the permanent damage to the economy has already been done, and that could roll over to the rest of the consumer goods that we consume. What's your take?
Well, first of all, the increase in oil prices that you've seen is anticipatory. It isn't reflecting shortages. It's reflecting the imminent prospect of shortages. We have lived on strategic reserves and floating inventory until now. If the blockade goes on, if the conflict goes on, and if the oil on tankers north of the Straits of Hormuz continues to be bottled in, then you're going to see real oil price increases. Those will truly be ugly. Right now, the difference between, as an example, West Texas Intermediate and West Texas Intermediate loaded available for shipment to the Far East is as much as $40 a barrel. So the $102 that you see on Bloomberg reflects 140 to 145 pre-shipping landed. If we go on 2 or 3 weeks and we use up the floating inventory, and countries that have strategic stockpiles use up their strategic stockpiles, you're going to see in much of the Southern Hemisphere and in the Pacific Basin very, very different oil prices. Mercifully, David, you and I live in North America, which at least is an integrated energy market, is well supplied. When people look at the Straits of Hormuz and they hear the headline, 20% of the world's supply of crude moves through the headline, what they don't read is something much more stark, which is to say that in excess of 50% of the world's export crude flows through the Straits of Hormuz. 35% of the world's LNG, the substitute, flows through the Straits of Hormuz. Mark my words, if this goes on, I'm not saying it will go on. If this goes on, it doesn't get worse. It gets much, much, much worse. The broader question about the economy is mixed. I'm not an economist. I'm a credit guy. But I would suggest to you that if we weren't already in a recession, that this conflict has tipped us into a global recession. That will have the odd benefit of reducing demand a little bit, but it won't do good things for the rest of your life. I also believe, as you and I have discussed before, that the stated rate of inflation is very different than the real rate of inflation. If normal people looked at the basket of goods and services that they compared, that they consumed, and they compared that with the price increases in the consumer price index, they would see just how silly the reported rates of inflation are. I think it's important that we note that. I suspect if we achieved peace in the Middle East, that you would see a fairly rapid decline in oil prices. You might not see them decline back to 60, but I certainly think you would see them decline back into the mid-70s. Looking further out, for reasons that you and I discussed as much as a year ago, namely the deferral of $1 billion a day in sustaining capital, the prices that you see today will likely be present in 2029, irrespective of the conflict in the Middle East, which is to say that today's price presages a price that would occur 3 years from now as a consequence of declining sustaining capital investment. So as an investor, you need to juxtapose all of those things when you're considering making an oil investment. I will say this, David. My justification to you 9 months ago for buying oil stocks was, first of all, that they were hated. And second of all, that the price had to increase as a consequence of sustaining capital deficits. I didn't include war. But I will say that oil clearly isn't hated anymore. As to where the price goes from here, I can't tell you how the Middle East thing's going to work out, so I can't give you a near-term impact.
This article, let me get your reaction to this. This is from the New York Times. It's been circulating all weekend. The oil shock is worse than you think is the title of this article. It highlights the divergence between current spot prices and the futures market. And importantly, in this paragraph, it reads, the futures and spot prices are rarely exactly the same, but the gap between them has grown unusually big in the past few weeks, so much so that oil executives and analysts say future prices no longer accurately reflect the extent of the supply shock that the world is experiencing. When you see a chart like this, Rick, this divergence between the futures and the spot markets, what is your first reaction?
Well, it has to reconcile. In this case, which way it reconciles is really a function of war. The futures market is of no use to a refiner that refines 300,000 barrels a day and has 1 million barrels in the tank farm. What that is saying to that refiner is that by Thursday, he or she is out of business. That's why you are seeing tankers that are outside the Straits of Hormuz commanding a $40 barrel a day premium to spot. It's also why something like 40 or 50 tankers worldwide are diverting from the region of the Persian Gulf to the U.S. Texas Gulf Coast so that at least they can lift a cargo. If the war resolves itself, then the reconciliation between the futures price and the delivered price falls. If not, I'm afraid both rise.
Do you think the futures market is agreeing with your analysis earlier, which is that oil is going to come back down? Is that why the futures price is much lower than the spot price?
To be honest with you, David, I have no idea. So I'm not going to for once. I'm not going to expose my ignorance. I'm not going to comment.
I think you're the farthest from ignorant that we know, Rick. But appreciate your candor either way. The impact of oil on the rest of the economy. Are we going to see any of that to the same extent as the late 1970s?
I don't know, but it's not pleasant. If you take a shock to the economy, like the increased amount of GDP that's going to energy, before the economy can resolve itself to it, it acts like a tax. There's less cash available for other uses. The second order effect is that it affects confidence. People are less willing to spend, they're less willing to invest, they're uncertain, so they do nothing. The consequence of what is in effect a tax, depriving the economy of resources and depriving the economy of confidence too, cannot in the near term have a happy outcome.
I'd like to get your take on this article from Fortune. This was dated late March, so it's not entirely news, but I will get your reaction. U.S. debt suddenly draws weaker demand as $10 trillion must be rolled over this year. Your commentary earlier on the private credit issues and just credit issues overall made me think about this particular story, and I had to pull it up. This past week, auctions of 2, 5, and 7-year Treasury notes all drew weak demand, forcing yields to go higher than expected. That's a stark contrast from the last month when Treasury offerings saw the highest demand on record in 30 years. The short end of the yield curve is under extraordinary pressure, extra pressure. Soaring oil prices boost the inflation outlook. As you know, the 2-year yield rose 50 basis points in the last month. What do you make of this story?
Well, I think, unfortunately, the story is accurate. Make no mistake, I don't think that the Fed ought to set interest rates. I think the market should set interest rates. If they do, that would be higher. But what's important to note is that increasingly the Fed is losing control of the interest rate. They lost control of the long-term rate a year and a half ago when, although they were driving down the short-term rate, the long-term rate decoupled from the short-term rate. Now you've had 2 straight weak Treasury auctions, and you have weak Treasury auctions in the face of something like $10 trillion needing to be refunded in the next 12 months. This is an interesting circumstance. The Fed has one choice, really, which is to print. If they allow interest rates to rise, they, at least in the near term, damage the economy, and not coincidentally, pardon me, damage the government's ability to pay interest on the $40 trillion that they already owe bondholders. If they don't raise interest rates and they have continued weak treasury markets, then they have to resort to printing, quantitative easing. Now, David, if you did quantitative easing, it would be called counterfeiting, and you would be put in the penitentiary. If you're an elected representative, of course, it's called fiscal management, and you get reelected. But either way, the outcome is not good. To the extent that they allow interest rates to rise, they do dampen inflation, they slow economic activity, they have a deleterious effect on the bond market, on the housing market, and on the government's ability to service interest rates. If they don't, they risk a real worsening of inflation, between a rock and a hard place.
We're entering a new phase of global competition, and it's no longer just about technology or trade. It's about who controls the raw materials that power the modern world. The Iran conflict is exposing the catastrophic risk of relying on one source for critical minerals and energy. While the Strait of Hormuz supplies 20% of the world's oil, here's another shocking statistic. China accounts for 80 to 90% of global critical minerals refining capacity. The U.S. and its allies are now actively trying to break their dependence on China, and the shift is happening very fast. Trump imposed steep tariffs on copper last year, and China responded by restricting exports of rare earths, and more recently, tightening controls over other key materials. This is part of a much bigger trend. Friendshoring is replacing China sourcing, triggering what many are calling the largest supply chain realignment in decades. At the center of the shift are 5 key minerals: gold, copper, uranium, lithium, and molybdenum. And that brings me to today's sponsor, Vanguard Mining, ticker UUUFF on U.S. exchanges. The company is available on Interactive Brokers, Schwab, Fidelity, and E-Trade. What stands out about Vanguard is its exposure across multiple critical minerals, all located in U.S.-friendly jurisdictions. Now, to understand the opportunity, you have to understand the imbalance. Take lithium, for example. After a major downturn, prices have begun recovering while China continues to dominate refining and processing, controlling a majority share of global capacity. Copper tells a similar story. China consumes and processes a significant portion of global supply, positioning itself as a gatekeeper for electrification and infrastructure demand globally. And then there's molybdenum, a lesser known but essential metal used in steel, pipelines, aerospace, and defense systems. China accounts for a large share of global production and has recently tightened export controls, highlighting just how strategic this material has become. Vanguard Mining has built a diversified portfolio across several of these key minerals. Their gold project, Brussels Creek in British Columbia, includes copper and palladium exploration upside. In uranium, the company controls over 19,000 hectares in Paraguay's Parana Basin, located near a major existing uranium project. In lithium, Vanguard has regained a 100% interest in the Poquitos 1 solar project in Argentina, giving it exposure to one of the world's most important lithium regions. And the company also has exposure to copper and molybdenum, tying directly into infrastructure defense and energy demand. Taken together, Vanguard Mining is positioned across 5 critical minerals, all central to the global push for supply chain security. Do your own research on Vanguard Mining, ticker UUUFF, a multi-mineral company positioned at the center of this global shift today. Speaking of inflation, what are you doing with your cash? You told me offline that you're raising more cash, selling the losers, but that makes me wonder how you're fighting inflation if you're in cash.
What I want to be doing is buying the single asset and mid-tier gold producers, because I think that the market is underpricing them relative to the seniors. I think the gold price will do well. I think that either those companies will re-rate or the big ones will take over the little ones, but that's not what I'm doing. I'm building cash. I have seen markets before where there's a crisis of confidence, where there's a liquidity squeeze. I'm not saying this is going to occur. I'm not even going to say it's a probability, but it's a strong enough possibility, and the penalty for failure is high enough that I'm building liquidity. The last time I saw concern about credit become a contagion was 2008. And I watched in a fairly short period of time equities markets lose half of their price support. The consequence of going into 2008 well capitalized and also well educated was that 2009 was the single best investment year of my career, percentage wise. During periods when other people don't have liquidity, having liquidity is what means that you take advantage of the circumstance as opposed to being taken advantage of. Now, the point you make is very valid. I'm getting paid something like 4% on my liquidity in a currency where I believe I'm losing 8% of my purchasing power, which is to say, arithmetically, I'm not making 4%, I'm losing 8%, or pardon me, losing 4%. I regard the 4% that I'm losing in real yield as being an option payment, an option premium to preserve my liquidity in case that liquidity comes in handy. The circumstance that you're seeing now in credit is challenging in many ways. I see the private credit conundrum as being partially the fault of very poor underwriting, and I see that in the commercial banks too. But I also see it in rising interest rates, which limits the availability and increases the price of credit, which makes credit less financeable. To the extent that credit concerns go beyond folks like me, to mas and pas, savers, that becomes problematic. In particular, David, and this is obscure, but you need to hear about it, there's a huge proliferation of products in the United States and Canada, high-yield ETFs, exchange-traded funds that invest in, for want of a better phrase, junk bonds. And they're owned by people who I inelegantly term yield whores, ma and pa investors who are chasing 150 or 200 extra basis points in yield with no knowledge of the credit risks that they're running. These ETFs are extremely liquid. There's trillions of dollars in AUM, and they trade billions of dollars a day. The difficulty is that the underlying assets that they own, over-the-counter bonds, high-yield bonds, are extremely illiquid. And if you have disintermediation, if the mas and pas that own these ETFs go to redeem them, the managers who run the ETFs may be unable to sell the bonds that would fund the redemptions. There you would get a run on the bank with no FDIC. I'm not saying this is going to occur, but it causes me a lot of concern. In that regard, it reminds me of nothing so much as the air in the CDO market before the 2008 real estate credit collapse. Repeat again, I'm not forecasting a credit collapse. I'm just saying that the possibility of it is high enough and the penalty for failure of it is high enough that I personally am building liquidity, despite the fact that in a real sense, that liquidity is costing me real yield.
Well, you operate a bank, Battle Bank. You know the banking industry better than most people. Are the banks better capitalized now than in 2008? And to another extent, is the FDIC more prepared now to backstop any such runs on banks?
The answer to that is yes and yes.
Okay.
The banks are both better capitalized. I would argue not well enough capitalized, but better capitalized. And collapse is on the FDIC's radar. So the answer to that is yes and yes. Now, the FDIC suggests that a well-capitalized bank has equity of 7% of total assets. Many banks are not well capitalized, which would suggest that they're running large balance sheets on a 5% equity slice. Our target equity slice at Battle Bank is 13%, falling to 10%. So, in other words, twice what the FDIC suggestion as to what well capitalized might be. I will also point out, however, that not all assets in banks are created equal. An example would be their derivatives exposure. A bank that has $1 trillion in nominal derivatives exposure will argue to the regulators, thus far successfully, that their ultimate liability is much less because their assets and their liabilities are offsetting. The difficulty with that is if one side doesn't pay, in which case the derivative liability becomes real. And when I look at the big banks and I see a bank with, let's call it $500 million in equity, and that is sitting behind a $60 trillion derivatives liability, I wonder how well capitalized they are. I'm not comfortable with that. I also look at the fact that in the United States and Canada, both banks are allowed to list debt securities on their balance sheet as held to maturity. So a bank that owns a 15-year bond that's selling in the market at 65 or 70 is allowed to carry that bond on their balance sheet as 100 because they, quote, intend to hold it to maturity, which is to say that the mark-to-market losses in bond portfolios in a rising interest rate environment has not been accounted for on bank balance sheets. I also point to the fact that there are as yet unrealized losses to private credit, and in particular to commercial real estate. We have been through a period in banking for 4 years where the ethos around large commercial real estate loans has been extend and pretend, which is to say that you've worked out an arrangement with the borrower that the borrower can't afford, but it allows you not to write down the asset in your balance sheet. I would argue with you that extend and pretend is coming to an end, even in a period where interest rates aren't rising, but interest rates are rising. So to suggest that the banking industry is as solvent as we would like to believe it is not true. You asked me if the banking industry was more solvent. The answer to that is yes. Is it solvent enough? No.
This brings me to a very important point. 2022 saw the banking industry under stress. As you recall, when interest rates started going up and there was mismanagement of duration, which led to the collapse of a few regional banks, as you recall. How do the banks today in 2026 in a rising interest rate environment prevent that from happening?
The truth is, sadly, that they don't. The banks, like the Mas and Pas, are yield whores. And the outside of the yield curve has higher yield. The banks believe as long as liquidity exists, that you can carry on your books a 30-year fixed mortgage, and you can fund that 30-year fixed mortgage with overnight deposits. When the deposit interest rate rises, the bank's spread gets constrained to the point where sometimes it goes negative. As you point out, this mismatch between the duration of assets and liability bankrupted the U.S. savings and loan industry. It bankrupted Silicon Valley Bank. It bankrupted First Republic Bank. This mismatch between assets and liability is one of the biggest challenges in front of the banking industry today. Mercifully for me, I've been in banking for 40 years. There's enough money to be made running a bank the way Ohio State runs a football team, which is to say good blocking and tackling. You don't need to mismatch your assets and liabilities. I would suggest to you that that's like bending over in front of a steamroller, picking up quarters. It's just a dumb thing to do.
Okay, going back to your cash statement for a minute, you are, stacking cash. I've observed enough successful investors doing the same thing to notice a pattern. Whenever they do this, they believe the valuations of whatever sector they're focused on or specialize in your case, the resource sector, is probably not at the optimal value to get in. In other words, you think it's overvalued. Is that what you believe right now? Yeah.
I don't. I think the smaller end of the gold sector is cheap.
Okay.
It's just I don't care what I think. I want to sleep nights and stay calm.
I see.
I have what is in a historical context too much liquidity in my portfolio. A financial planner, or frankly, a Rick Rule looking at my portfolio 2 years ago, would have said you have too much liquidity. You have a lazy balance sheet. Right now, lazy feels just right.
So you're not doing this because you're expecting a 2009 moment to get in. That's not what you're doing?
I think there is less than a probability of that occurring. I just think that the penalty for failure is too high. Buffett will tell you during the time he's operated Berkshire Hathaway that the share price has fallen 50% or more over 18 months, 4 times. Anybody who is in the equities markets who isn't prepared for a 50% decline shouldn't be in equity markets. I've been in equity markets for a very long time. I think there's a less than 50% chance of it occurring, but I think there's a more than 20% chance of it occurring. And if it occurs, I'm afraid it gets underway in earnest. The difference between taking advantage of a liquidity squeeze and being taken advantage of in a liquidity squeeze is simply liquidity.
Well, I'll remind the audience, by the way, that Rick's call on silver and gold have been rather appreciated. In fact, as another reminder to the audience who haven't followed our previous interviews in the last couple of times Rick's been on the show, late January, Rick sold 80% of his physical silver holdings. He said this several times at the Vancouver Resource Investment Conference. He said this on my show days after it aired. Silver went down 30% in a single day. Silver is currently trading at $75. It's been trading range-bound since mid-March. What are you doing now with your gold and silver holdings?
I increased my gold holdings because gold functions for me as liquidity. It's a savings asset. Silver occupied a speculative place in my portfolio. I bought silver originally because silver was hated. When it ceased to be hated, the reason to own it in my account went away. So I had to say, what's the best use of speculative cash? The decision was made easier for me because there was a hyperbolic up move in silver, what you Canadians call a hockey stick graph. I've learned that the backside of a hockey stick graph is just as steep as the front side, but it's a lot less fun if you happen to be long. And so while many people get attracted in a positive sense to a hyperbolic up move, I get attracted in a negative sense to a hyperbolic up move. I decided specifically that since the reason I owned my silver went away, that there were better speculations for me than silver. So I exited silver for other uses of capital. I did not exit gold. In fact, 20% of the money I made, 25% of the money I made selling my silver stocks, my physical silver, I used to buy physical gold.
Let's talk about uranium. You've actually retweeted this, but there's the sense of growing resource nationalism spreading from Brazil to Africa to Middle East about how countries should preserve their critical minerals. And where I'm going with this is, how does uranium fit into the global picture of critical minerals that have become front and center on headlines all over the world?
Uranium is actually the greatest beneficiary, I think, over time of the Gulf conflict. You will recall, or perhaps you weren't because you're too young, but the Japanese nuclear fleet and most of the French nuclear fleet was built as a consequence of the Arab oil embargo of the early 70s. Uranium offered the only commodity that was energy dense enough that a nation could store all of the fuel that they needed in one warehouse to sustain the country's economy for 5 years. We're relearning that lesson right now. No country more thoroughly than Japan. The most important near-term determinant for the uranium price is simply the refueling pace in Japan among Japanese reactors. There's a 41 reactor fleet. They've restarted 16 plants. The Japanese now have the impetus to start their remaining nuclear fleet. And that takes uranium now, not uranium 3 years from now or 4 years from now, not uranium that's contingent on a data center or small modular reactors. The energy security afforded by uranium at the same time that the world is desperately short of baseload power and would prefer non-carbon generating power means that the clearest of all beneficiaries of the Gulf conflict is uranium. And that will play out in the market over the next couple of years.
Well, this came in from Bloomberg late December last year. Nuclear industry to add 15 reactors next decade after 2025 decline. The nuclear industry expected to switch to 15 reactors globally in 2026. More than 50 new reactors are set to go into service worldwide from 2027 through 2030. I wonder how permanent is this trend. Rick, you'll recall Germany, as an example, was a leader in nuclear production, and that peaked some point a couple of years ago, and then now their nuclear energy production has declined to near zero. So what was a mega trend for them was only transitory in retrospect. What contributed to the, I guess, fallout in popularity of nuclear energy in Europe? And can we see that trend come back?
I'm not European,
Okay.
Maybe visually, but not culturally. So I can't say. I mean, there was a whole succession of stupid energy choices that Germany in particular made. And it's absolutely beyond me as to why they made them. I just have no earthly idea. Ironically, carbon was something that was important to the Germans. So now they're having to burn more coal than ever. How does that work? Their grid is substantially less reliable, and German people's electric bill is up fivefold in 12 years. That will point, I think, wonderfully to the failings of their product. Nuclear has gone in a very short time from a period of time when I, as a nuclear proponent, I expected to see my face on a post office wall, on a sort of a most wanted poster. And now my government wants to subsidize me. Now I feel like I was cleaner when I was on the most wanted rather than being subsidized. But that's a different question. What it suggests is that there's a population around the world who is perhaps more technologically sophisticated and is concerned about carbon loadings, and one that recognizes that the world needs more of all forms of power. If you combine those two things, non-carbon generating, cheap baseload power, there's one alternative, which is to say nuclear. That doesn't make me anti-solar. It doesn't make me anti-wind. It doesn't make me anti-oil and gas. It doesn't make me anti-coal. The fact is that material standards of living around the world, if they're high, are energy dense. On the one hand, there's 1 billion people on Earth with no access to primary electricity. We will electrify the world in the next 20 years. That's going to require more electricity of all sources. At the same time, people who live in parts of the world that are already electrified want a higher standard of living. And that is very, very, very energy dense. I will say that although I'm not a technologist, I'm a skeptic as to the amount of energy that's likely to be consumed by great big data centers. I have a belief that if you throw $5 trillion or $10 trillion at a problem, that you find ways to develop solutions to that problem cheaper. I don't know what they are, but I suspect that some of the great scientists alive in the world today will find a way to make artificial intelligence and data acquisition much less energy intensive. So that to me is a bright spot.
That's already happening, actually. On that note, RAM chips makers are suffering or have been suffering the last couple of weeks. You'll recall Micron stock went down because Google announced a new turboquant model that requires less memory. And so who knows what that's going to do to copper, for example, or other raw materials.
And I think that's important for people to recognize. Copper demand is supposed to increase between 2.5% and 2.5% compounded for 10 years without AI. You add data centers on top of that. If you believe that, I talked to Robert Friedland the other day, and Robert was telling me that with the projected demand for data centers, that we will consume more copper in the next 15 years than we've consumed in the history of humankind. If you take data centers out of the equation, it will take 30 as opposed to 15 years. In either case, as an example, the case for copper and the case for uranium is very clear.
When it comes to uranium and copper producers, or any resource investor, resource stock rather, but let's just focus on uranium as an example. Is it conceivable that abroad in Kazakhstan and China and other countries around the world where uranium production is much cheaper, where North American companies are competing against companies that have much higher margins and lower operating costs? How do North American producers, the Camecos of the world, stay competitive?
Well, I would argue with you that Cameco is the most competitive uranium producer in the world.
Okay.
Certainly they have higher systemic costs than most, but they have a pretty wonderful track record of on time, on budget completion. The Kazatomprom was the lowest cost producer, but Kazatomprom seems to have had a major exodus of middle managers, as an example, and they have been unable to restart Inkai successfully, which was, of course, shut down during COVID. The bottom line to all that was, were I a uranium investor, and by the way, I am, I would focus on Cameco. I was uncertain about Cameco the first time that you and I talked some years ago, because I wondered when a uranium mining company buys an engineering firm like Westinghouse, how they're able to manage two businesses. And I was afraid that both businesses would suffer. Turns out they managed pretty well if you look at the balance sheet and the income statement. So what Cameco seems to have done is transformed themselves ultimately from a miner of U3O8 to a seller of watts, fully integrated, which is extremely important. It's also important to note, and I know a lot about Cameco, that material that they regard as waste would be regarded as ore by most companies. Do they have challenges? Yes. Ironically, some of the uranium that they mine is of such high grade that you have to mine it robotically. You can't put humans down there, it kills them. That's a wonderful challenge to have.
The challenge with uranium investors, I guess for my audience, is that similar to other resource stocks, we don't know who's got the better deposit, who's got the better grade. How do you apply geology to uranium?
That would take a whole show, David.
Okay.
I have the answer to that. We did a whole 8-hour-long uranium boot camp.
Yeah.
To teach investors precisely how to do that. It took us 8 hours, and I'm not sure we got it done after 8 hours.
Well, that you can tell us where we can find that information. And by the way, you can tell us what we can find at the Rule Symposium. Has the Rule Symposium agenda changed in the last couple of weeks? I know you've been planning this for quite some time, even before the Iran conflict begun. But since February 28th, have you changed the agenda for what to focus on?
We haven't. We have a 30-year track record from that conference, going all the way back to throwing the conference in Vancouver. And we learned that there's a format that works for us. You have big picture people talking about the interplay of politics and economics and what you need to know to invest. And you have ones that you'll never hear on CBC or CNBC or Fox. People who tell you about the world the way it is, as opposed to the way that conventional media thinks it ought to be. And then we have portfolio managers and securities analysts who have real world experience in natural resources and precious metals for 40 years, not 4 months. That's a pretty powerful combination. We have exhibitors at the conference who've all been vetted, unlike other conferences. And to top it all off, we have a money back guarantee. If you attend our conference, either online or via live stream, and you think for any reason you didn't get your money's worth, we give you your money back. What we aren't is particularly flexible. We couldn't anticipate the war in the Persian Gulf, and we've made no attempt to secure a speaker who could speak well about it, because we don't think in the near term there's much that one can know. The outcome of the Persian Gulf crisis will be very well known by the time we put on the conference. If the Persian Gulf situation lasts for another 4 weeks and we run out of floating inventory in oil and gas, and we run out of strategic supply of oil in particular in economies like Korea and Pakistan and Sri Lanka and India, the impact of that crisis will be very well known and unfortunately not very pleasant. If, by contrast, we solve the problem in the Persian Gulf in the near term, and we normalize oil supply, we will have to deal with the hangover, with the shock that was presented to the global economy. And we will also have to look at how various nation states, various geopolitical blocs, deal with increasing resource nationalism and a competition for resources that I think will shape resource markets for 10 years anyway. And we will cover that topic ad nauseum.
What do you think is the next Strait of Hormuz? In other words, this crisis has brought to the world's attention the importance of choke points. Any other strategic choke points in the world that you think is critical to monitor?
I don't think as critical. Certainly the Malacca Straits are critical in terms of taking material to China, but there is the long way. If you shut down those straits, you could go around New Zealand through the Pacific. There's no other concentration that I know of, save perhaps the English Channel or Gibraltar, that offers the same narrow focus or the same concentration of commodities. As I noted before, the Straits of Hormuz doesn't just transit 20% of the world's oil supply. It transits well in excess of 50% of the world's export oil supply. So if you're an importer, it isn't a 20% problem, it's a 50% problem. Similarly, liquefied natural gas. Similarly, sulfuric acid. Similarly, helium. Similarly, nitrogen and nitrogenous fertilizers. This is a very, very important, very, very unstable place. And a whole bunch of the commodities that the world relies on transit through there. And a separate problem in terms of the threat. This isn't just a geopolitical threat between Israel and Iran or the United States and Israel and Iran. This is potentially a focal point in a millennium-long schism between Shia and Sunni Islam. And to the extent that the largely Sunni Arabian Peninsula had greater feelings of enmity towards the Iranian Shias or vice versa, this is a circumstance that could spiral out of control for reasons that nobody had anticipated as a consequence of the current conflict. I'm not saying it's going to happen. I'm just saying that this is a historically unstable region that is unusually important in the transshipment of the raw materials that run the world.
Well, finally, the service that you provide, which is to rank junior investing stocks. Before we talk more about your ranking system, I wonder if your submissions lately have changed in terms of trends. Have you noticed, just based on observing what people have been submitting to you to rank, that people have shifted their allocations from one sector to another, or one preference of stock to another?
What has happened really is that the volume has just increased. People are increasingly uncertain. The consequence of that is that rather than being 2 days behind, I'm 6 or 7 days behind.
Okay.
People who forward their stocks to me are usually people who have heard about me through web broadcasts like this. Often that's resource-centric investors. And more often than not, the portfolios that are submitted to me are portfolios that they're concerned about, often meaning that they're heavily populated with very low market capitalization, very volatile stocks. And I suspect that that hasn't changed whatsoever. What began to change 6 or 7 months ago was the number of energy stocks in the portfolio. And I suspect that that changed as a consequence of my own increasing focus on energy and my speaking to audiences who might already be predisposed to energy, which is to say, I think it's more localized rather than as a function of broader market trends.
So no real shift there. All right. Well, tell us where we can find your work. I noticed I mentioned the Rule Symposium, which people can check out. I'll put the link down below. It's coming up later in July in Boca Raton. Just give us, we already talked about it, so give us a sense of where else we can find you and what you've been focusing on these days, Rick.
The first place to get in touch with me is what you suggested with the portfolio review. If you care what I have to say about natural resources and you want to personalize it, you can do so for free, a very good price. Go to ruleinvestmentmedia.com, list your natural resource stocks, and I personally will rank them 1 to 10, 1 being best, 10 being worst. I'll comment on individual issues if I think my comments might have value. Please, no crypto. Please, no tech stocks. Please, no pot stocks. I don't do any of those. I have done personal due diligence in marijuana for 5 decades. So please, natural resource stocks only. That's meant to be used in conjunction with the lessons that we teach for free in the Rule Classroom. Almost 30,000 investors now are regular visitors, subscribers to the Rule Classroom, where we have over 300 hours of free educational programming to teach you to be a better investor in natural resources and precious metals. New features coming every week, including every Thursday, a free question and answer session with yours truly, talking about individual stocks. We also have, every 90 days, a boot camp. We have one coming up April 16th, which is to say this coming Saturday, about copper. 8-hour-long deep dive into copper. $99 free to attend. The tapes, the recordings available for a year. You'll need them because we're going to give you more information in 8 hours than you can absorb for 8 hours. And an absolute gold-plated money-back guarantee. And then our granddaddy product, as you suggested, the Natural Resources Investment Symposium in Boca Raton, Florida. July 6th through 10th in Boca Raton, Florida. I think the finest natural resource conference in the world. Whether you attend live or via live stream, we'll give you 46 hours of programming in 4 hours, which is more than you can absorb. We'll give you access to the tapes, which you'll need, And both the boot camp and the symposium come with a solid gold money back guarantee. If you think for any reason that the information that we taught you isn't worth the price that you paid, no problem. We will refund the money.
Okay, we'll put the links down below. So please do make sure to check out all of Rick's work, including the Rule Symposium coming up. Very excited to be going there firsthand and covering the event. Thank you so much, Rick. Appreciate your thoughts today.
David, I really look forward to hosting you down there. I think you'll really enjoy the symposium, and I know that we'll enjoy having you.
Absolutely.
Thank you for your support of it.
Thank you for inviting me, and thank you for inviting us to attend, and thank you for watching. Don't forget to like and subscribe.